There's a prevailing notion that Toronto investment properties don't cash flow. So for the newer clients that have just discovered how good Toronto freehold investments could, they often tell us how surprised they are by it. Honestly, the biggest downside is the difficulty of qualifying for properties in Toronto because of the higher purchase prices. But lately, the bar here is getting lower. These days, it is possible to find a house in Toronto for under $1 million that cash flows over $1,500 per month, even at 6% interest rates, which is an eye-opener for many investors. Now, if you're intrigued too, keep watching. Let's dive right into our favorite Toronto investment property class. I'll cut right to the chase and show you the numbers. With the new multiplex rules, only in Toronto, you can now split single-family homes into up to 4 units, plus a garden suite or a laneway suite in the backyard, making this 5 units. Now, this eclipses the typical already increased 3-unit limit in most of Ontario, and because of the higher interest rates, the prevailing market uncertainty, combined with a slower summer for real estate on average, there's a lot more to choose from if you are looking at under the $1 million mark in Toronto. Now, you will have to put in the work to add extra units in the house for the ideal setup, and this might cost around $100,000 to convert a starter house in Toronto into 3 units. But then afterwards, this would translate to $1,500 of positive cash flow per month. This ends up being better than the average secondary market and much, much better than Toronto condos. And then once you add in that garden suite, the numbers look even more convincing in Toronto. Let's talk a little bit more about values. Now, Toronto is a much more mature market with a more diverse economy, and that does translate to more stable property values. Just take a look at this chart where we do compare Toronto single-family homes to those of Kitchener-Waterloo. Toronto is our top pick, but the outlook of KW isn't too shabby either, being coined the Silicon Valley of Canada. But what happened though is that KW prices went up more than Toronto during the pandemic and also because of low interest rates, but then dropped more once interest rates went back up. So the fact is secondary markets are more volatile and have a higher price risk. What this means is that you could potentially lose more if you buy and sell at the wrong time in the secondary markets. Next, let's touch on capital requirements. And we mentioned this before, if you choose Toronto, you will definitely need to pay more. But the thing is, if you choose projects that need renovations, and realistically, this would be a lot of projects that is available in the freehold space, renovations costs, regardless of where you are about the same. So once you factor in similar levels of renovations, that gap between secondary markets and Toronto end up being even closer. Now, going back to the potential for 5 units in Toronto compared to only 3 units in the rest of Ontario, here's where things get more interesting. If you actually successfully make 5 units, then this allows you to potentially qualify for the CMHC MLI Select program. In this program, the best case can get you as low as a 5% down payment, better rates compared to the big bank floor rates, up to a 50-year amortization and limited recourse. So this definitely opens up a lot more room for growth for real estate investors. I'll try to make a separate video about this later, but if you want to dive into this a little bit sooner, I'll put a link down below where you can get more details on this program. Believe it or not, the freehold investor demand in Toronto has actually been pretty stable throughout the rate hikes. What we have been seeing is that people who used to invest in the secondary markets are now exploring Toronto because of the better opportunities, and Toronto condo investors are also shifting gears to houses. So even though the real estate investing demand has definitely dropped in general, Toronto freehold investing has been a lot more stable compared to the other Ontario real estate asset classes. So to sum it up, if you want to invest in these opportunities in Toronto, here's what you need. Number 1, you need to make sure you have enough capital for the down payment and closing costs, which is around $225,000 at least, plus most likely renovations where you would have to put in more money and more time, likely around $100,000 on average, and 3, be able to qualify for close to an $800,000 mortgage at least. Obviously, there is more to it after that, but that's where our team comes in. We're a real estate sales brokerage that focuses on investing in freeholds in Toronto, and we'd be happy to show you opportunities that make successful conversions, generating the best ROI and the blueprint on how to get this done. Just head over here to book a Zoom discovery call with us to get started. Now, if you found this video helpful, show us your support by giving this video a thumbs up and hitting that subscribe button to stay up to date with our content. Our channel covers a wide range of real estate and investing topics in Toronto, from market trends to housing policies, interest rates, and investing strategies. We want to make your real estate investing journey easier for you, and so we offer services like planning, analysis, buying and selling, renovating, leasing, and property management. For more information, visit our website or find us on social media. Thanks so much for watching, and I'll see you in the next video. Bye.